All right, guys, AT&T reported this morning, and the reports were a little mixed. So one of the things you'll see is they talk about the fact that revenue is down. Well, you got to remember, they split off their video division and they sold off a couple of other components of the company because AT&T's goal is to focus back onto their phones and their fiber and really grow that business and hyper-focus on that, okay? So if you see, this is their actual press release when they announced all the earnings. If you look right here, revenues were down from $35.7 billion down to $29.6. But again, the impact of U.S. separation. If you take all that out, they grew 2.2%. So that's the good news. And remember, guys, AT&T is not some super sexy, fast growth company. It's AT&T. Like, you know what I mean? Nobody is out there going, oh my God, you're not going to believe this killer stock that I own. It's called AT&T. I mean,
not many AT&T fanboys.
Zero AT&T fanboy. Who's the CEO of AT&T?
Not Lily, the girl on the commercials.
Isn't she Sprint?
I have no idea.
Was she AT&T or Sprint?
She's AT&T.
She's AT&T.
Oh, okay. Well, there you go. So either way, these things are the things that happen. Again, a lot of this has to do with their combined businesses because they split off their other company, the video division. They wanted to make sure it was a separate entity. They probably thought we have a lot of value here, which they're right. They have a lot of value here. Let's go put it in a separate business. Because remember, guys, when you bury a bad business in a good business, it makes just the good business get worse in value. So split up the bad business that had its own value, or keep the bad business and split up the good business. It's separated. The parts are worth more than the whole. That's the idea there. All right. So for some more information on them overall, and this doesn't have any reference having to do with any comparison. Revenues, $29.6 billion, EPS, 59 cents, adjusted EPS, 65 cents. Cash from operations, 7.7 billion. Capital expenditures, 4.9. That means free cash flow of, that doesn't even make sense.
Poor. No, that's right. Free cash flow.
No, because cash from operations less your capital expenditures. That should be 2.8, and it says 1.4 billion. Further clarification, explanation of non-GAAP. Okay, that's probably why. But cash from operations less your capital expenditures. So overall, this is the first of many quarters. Not the first quarter, but these are a lot of quarters here having to do with AT&T by its own business. Now let's look at their mobile. Record levels of customer additions for their mobility. The AT&T fiber, by the way, I had AT&T fiber and I loved it.
Oh.
Yeah, it was great. And I'm hoping that the new house that we're closing on today has AT&T fiber. Spoiler alert, probably doesn't. So do you use AT&T fiber at your house?
No, we don't have it.
Oh, you don't have it in your area?
No, there's no fiber in the area. So you never know. I mean, you live in kind of a more popular area over there.
Yeah, but it's 15 acres by itself on a road that has 12 houses on it.
You never know.
I know.
There's a lot of those communities down south in like rural Ohio that have fiber.
Come on.
Because it's cheap to get in there. So they're just going there and just putting fiber in all these places. They have better internet than I do.
Wow. All right.
Yeah, Mo still has to send carrier pigeons when he buys stocks.
It's ridiculous. I just got off Pink Slips.
So here's their communication results, okay? And here, all this data here, guys, it's all great data, but I want you to focus on a few things. I want you to focus on looking at the company on a long-term perspective. If you're new to this channel, I'm Paul, and I am a value investor. I don't care about day-to-day or quarter-to-quarter results. They don't bother me one bit. The only thing I care about is, are there major changes in the company that are affecting my long-term thesis on the company? My thesis on AT&T is boring as hell.
Yes.
It's not going to grow much.
Dinosaur.
It's a dinosaur, right? So if you like what I'm saying here, don't forget to subscribe to the channel, but let's go look at AT&T on an 8-pillar basis right now. So this is our 8-pillar software. For those of you who are already subscribers and subscribe to the software, part of our community, just follow along. If you're new to it, you're going to love this, and it's going to be a great learning experience. So they're down a lot today, but they did hit as low as $17 a share. And here's the stock over the last 10 years. It's gone nowhere, guys. Absolutely nowhere. Right? Now, they've had a very healthy dividend for a long part of the time. And right now, the dividend is a healthy 5.8%. Now, keep in mind, though, last year, when it had everything together, it was like an 8% dividend. So their argument was, our stock is still a really high dividend, even though they cut the dividend.
So didn't today's minus 7% drop just cut our dividend to zero? Is that the way you can think about it?
No, the dividend yield goes up. Think about it. Dividend yield is dividends divided by share price. So if the dividend is $1 and the share price is 10, it's a 10%. If all of a sudden the stock goes to 8, It's now 1 out of 8, it's 12.5%. Great question, Seth. Guys, this is all non-scripted. Seth literally asked that question.
I'll be darned.
Exactly. So
and that's why you saw all those companies during COVID that were paying a healthy dividend, and then it just skyrocketed
because the prices collapsed.
Whoa, can they afford this anymore?
I never knew this.
Oh, absolutely. So the question you have to ask yourself is, can they afford this dividend? That is what matters here. The $15 billion. So we look up here at the 5-year average free cash flow, $24 billion, and they can afford it. All right. So let's go through our 8-pillar process. Pillar number 1. We want the 5-year PE of the company to be 22.5 or less. So on a main page of our software, Seth, look at this, 8.7.
I was going to say, our software users love these low PEs. They always queue up these requests to talk about these companies.
Absolutely. Because low PEs are, listen, no pillar we're looking at right now in and of itself is a be-all and end-all. It's about looking at the whole picture for the whole company. Low PE, love it. But if I were to tell you the business is going to lose 50% of its revenue every year for the next 10 years, it'll basically be a zero business. This isn't low enough then. But if it's going to grow 50% a year for the next 10 years, guess what? I'm going to pay 38 times 5-year earnings. That's the point.
Pillar number 2, Paul.
Pillar number 2 is a 5-year return on invested capital. We want to be greater than 9%. Right here on our main page, it's 5.3. That's an X. Fully expected this to be a low return on invested capital. They're not getting a high return off the money invested in the business. This is a slow growing business with probably not a lot of options on things to go invest in, correct? So you expect a lower ROIC. That justifies this low PE. Pillar number 3, very simple, revenue growth. I just want revenue growth over the last 5 years. So we go to the income statement, go 5 years ago, 159 billion. Last year, 163. Check mark there. Look at this growth.
Nothing. Well, down.
It actually is down, exactly.
Mm-hmm.
Pillar number 4, we want net income growth over the last 5 years. So we scroll down. 5 years ago, they made 30 billion. Last year, they made 17. That's an X. Now, I'm sure in this 30 billion, because you can see, guys, whenever I see a big number like this, look at it's just a random big number here.
There.
Just like this one is a random big loss here, right? So there was probably some sale of some division that was a big jump.
If you're following along at home, we're giving you 8 metrics to finally look at a stock and start understanding the company behind it. Paul, pillar number 5 is shares outstanding.
So this is the silent killer for investments. When I hear people not look at the shares outstanding, you don't know if the company is issuing out shares to raise capital, you are being diluted as an owner. If there are 10 shares in a company, you own 1, you own 10% of the business. If they increase the number of shares by 2 more to 12, you now own 1 share out of 12. You still own your 1 share, but it's out of 12 now. Now you own 8.33% of the business. That's the key here. So we scroll all the way to the bottom and we look 6.17 to 7.18. That's an X. Their shares outstanding have gone up. Now, in fairness to them, it looks like there was some sort of acquisition done here, and that's why they probably issued shares. And since then, they've been declining. But over the last 5 years, it's still an X because we got to stick to our rule. Pillar number 6 has to do with long-term debt. So debt works for a company the same way it works for you as a person. If you and your neighbor have everything the same income, same family, same house, same car, same everything, but they have $10 million in debt and you have 0, you are going to be a lot better financially off if bad things happen, if the economy slows down, if somebody loses a job. Same thing with the companies. So what do? We go back to our main page, look at the 5-year average free cash flow, 23.9 billion. Let's just call it 24. Multiply it by 5. That's $120 billion. So we want their long-term liabilities to be under $120 billion. So we go to our balance sheet. We scroll all the way to the bottom here. And our long-term liabilities are $308 billion.
Uh-oh.
That's an X. So a lot of debt in this company. Seth, what does that mean?
Well, there are tough times ahead. And so with a lot of debt, this company is going to have a harder time, staying afloat, right? I mean, we want that to be low.
Yeah, it's just, especially we were in a low interest rate environment before. And now as interest rates go up, let's say interest rates go up 3%. That's $10 billion. That's $9 billion extra dollars they got to pay when they refinance this stuff. That's $9 billion straight out of the free cash flow of the business. So the business was cash flowing $24 billion. They're down to 15 just like that. So if you have $25 billion in free cash flow and your debt goes up by 3% on $300 billion, do the math. 3% of 300 billion is $9 billion. You've now taken your free cash flow from 24 billion down to 15 billion. And all of a sudden, your $15 billion in dividends aren't working out anymore.
This is why I need you, Paul, because I would never think of any of this stuff.
Oh, well, you're welcome. And that's the key here. So pillars 7 and 8 have to do with free cash flow. Free cash flow, I believe, is the lifeblood of the business. You can do one of 5 things with free cash flow. Should we quiz Seth on this?
Yes, you can.
Okay, let's hear the 5 things.
You can buy back shares. You can buy a business. It took me 4 years to get to this, Paul. You can buy back shares, buy a business, invest in yourself. You can pay down debt, put out that dividend. And look, I even messed up my note because I...
Yeah, we already said the 5.
Okay, great.
So yes, you can do any one of those. You can do all of them. You can do none of them. It doesn't matter. But this is a real way I look at a business to see how they're operating. So on our cash flow statement of our software, we go down here. I actually put this line in here to make it easy for our users. That way you don't have to do the math yourself. 5 years ago, they did 17 billion in free cash flow. Last year, they did 20. So that's a check mark. But keep in mind here.
Down from 29.
Yeah,
Dale.
that's the thing. Now, I don't know what's going on with the business in the future. So even though it's a check, is it a downward trend? Is it an upward trend? Are they restabilizing? What are they doing here? That's the key to figure out. Our final metric, pillar number 8. We take this 5-year average free cash flow of 23.9 billion and we multiply by 22.5 to get a value similar to the 5-year PE. So 24 times 20 is 48, 4.8, 480, 4.8, 500, call it $520 billion. So we want to pay a market cap less than $520 billion.
Really?
Guys, yeah, it's way lower.
Oh my God, 136.
136, 137.
Oh gosh.
So you might sit there and say, let's buy it. Again, we don't know. That debt level is very bad. There's a lot of value investors out there who would sit there and get worried about the debt levels.
I don't want to do any of that math, Paul. That was too hard.
Exactly. So for those of you who stuck along with the math, thank you. But this is why we have the 8 pillars tab in our software. It does all the math for you. Look at this 5-year free cash flow multiple, 5.75. Again, though, the big key here is the debt level. The debt level alone scares me. I avoid AT&T because of the debt level alone. Now, if you like this stuff and you like the math and you've stuck around long enough on this thing, I am going to sit here and talk about a very important project that I am working on and have been for several years. Sports, which AT&T is going to make a lot of money off of their streaming, their fiber. Sports are a very active thing. You're probably a fantasy sports player. We have a fantasy sports game called dynastyowner.com where you actually manage a business from the GM, owner, and coach perspective. It brings all the fun of regular fantasy sports and fantasy football and also makes you the guy who operates the money, the salary caps, the trades. Things cost money. Releasing players costs money. It's the real business of sports, but for fantasy football. Actual player contracts. You own the team and you have the player for the entire duration of their contract. You don't just draft once. It's the best of dynasty leagues, keeper leagues. So for those of you people who love it, go to dynastyowner.com. And if you sign up, there is a promo code EM10, EM10 on Dynasty Owner. You'll get a discount. Thank you very much, guys. Please go check it out. But let's go look at what we want to pay for AT&T stock based on the numbers today.
Before we get to that amazing stock analyzer tool, Mo, in your 20 years of expert trading, what have you seen with a company like AT&T? Because this is a popular one, but probably not for day trading, right?
So I will say this is for day trading, no, but for long-term trading, this is a great stock to trade. Historically, it was because it moves so slow. So it can move up through the sweet spot, down through the sweet spot. You can go long and short on this thing. But really what everybody wants to focus on is today. What do you do? Today was earnings. Stock's down now 7%. It was down over 10%. Was it down 10% earlier today? That was a huge fall. I would not even touch it today. This trend will change. But this gap has to fill. So a lot of stuff has to go on here. Now, the one thing that I'm very impressed with right here, and it's these moving averages. Look at this. Look at what AT&T did today. It dropped all the way down to this level, and it sucked itself right back up to that 200-day moving average. Isn't that incredible? But there's also one more way you could do this. Day trade it. This thing was down all morning. This was all pre-market trading. And look at this resilience throughout the day. You got an engulfing candlestick. This could have actually been, you could be in this right now. This could be a pretty good day trade. I'm quite surprised, but this is a way that you can go at this from multiple different ways. I'll teach you how to do it in the Bid and Ask Nation.
All right, folks, we're going to now transition to what you should be paying for this company, and we're going to use math and metrics to get to this price. Go ahead, Paul.
All right, so our stock analyzer tool is extremely popular because the future is unknown, but you can put your assumptions in for revenue growth, profit margin, free cash flow margin, future PE, et cetera, and your desired return, and it'll tell you what to pay. So for AT&T, not a fast-growing company, I'm doing a 10-year analysis. I'm going to go with 0, 2, and 4% revenue growth. Profit margin, I'm going to do 8.5, 9, and 9.5. Free cash flow margin, I'm going to do 11, 12, and 11, 12.5, and 14. For PE, I'm going to go 8, 10, and 8, 11, and 14. Same with free cash flow. And finally, it's a big company. I just want my margin of safety over the market. I'm going to do 12.5% return. Gives me an ample margin on my investment. I hit the analyze button, guys.
What's it show?
The stock is currently $19. All right. It's all the way green over here. So what does this mean? First off, if you have the stock, just put in here, add it to your watch list at this price, and it'll notify you when it goes below $18.99. But the way I look at this, guys, is it's getting close to my spot. But remember, go understand the debt and make sure you're comfortable with debt. I appreciate you watching the channel. Thank you very much.